We can see it.
Yes.
Okay,
Yes.
awesome. Thank you. Thank you. First of all, thank you. Really appreciate everybody for joining tonight. I know it's middle of the week, and almost all of us, we have W-2s and the kids and all those errands at the house. So we appreciate your time. On that note, it's going to be about 15-20 minutes or so. We'll talk about the slide, and another 20-30 minutes will be on the Q&A. And then typically we take a break after the hour, then we come back for 20-30 minutes. We do what Mike calls it after hours party. So we talk about other things. If you have any questions, we just take on follow-on questions and things like that. Okay, so agenda for the day. I'll walk you. I'll introduce our sponsor teams. Then Paul is going to walk us through on the summary. Then I will have Andrew, and the third partner. It's going to walk us through on the location and business plan. Then from the massive perspective, we'll recap how to invest with us. On that note, Andrew is running a little late, and so hopefully he gets some on time. If it's not, I'll continue with the conversation, and we'll go from there. All right. It's investment summary. I mean, a full disclaimer. Please, I'm not going to read it out, but I just want to kind of share. It's a 506C. All the things that we talk about here, those are based on our assumption. Please do your due diligence before you make investments.
Hey, Schreier.
Hey.
Before we go too far, let me make a couple announcements, non-deal related, and then I know you may cover them again at the end.
Okay.
So Sanjay and I, Mike Bailey, will be in Atlanta Friday and Saturday. So we're going to be coming in on Friday, going to go visit Macon, Georgia, visit some of our properties there. And then we will also, I'm going to be presenting at an event, a meetup on Friday night in Atlanta. So if anybody's in Atlanta or that area wants to come by, it's 5:30 p.m. on Friday. We can drop the link in here in a minute if you want to come to that. And then Saturday we're going to visit another partner operation in Warner Robins. So it'll be a busy weekend. Oh, I forgot, Kyle Bailey will be going with us as well. So we have a few people from Massive that'll be out there. So come and join and have a good time with us.
Sanjay, you want to add something to it? Yeah, thank you. Sanjay, would you like to add something to it? How many assets you're walking that day? So don't mind sharing with others.
Yeah, no, that's good. It's funny. I found out that one of my office tenants, we were talking, and he's like, "Yeah, I'm gonna be in Atlanta. If you need," we were trying to meet. I can meet you in Atlanta. I was like, "Oh, I'm gonna be there." And he sold his business for $750,000, and his buddy who sold his business for $14 million is going to be in Atlanta this weekend. So I might arrange something with them in addition to all these multifamily properties. So we'll see.
Hey, point is, if you're in the Atlanta area, please, if you want to shake hands, please join us. And I'm gonna miss the whole party, and I'm jealous. Maybe next go around. So have fun. You guys have fun. So on that note, that's Sanjay. He was just mentioning. Then Mike Bailey, and that's me right here, and we have our team. We have Trevor on the call, and Jasmine. Ramiz is out today. Jasmine is in 10X, and Maria, I don't know if she's here or not, but that's our team. And if you guys have any questions, if anyone has any questions for this project or any other process, please reach out to one of us, and we'll get back with you right away. So that's our team. So for us, when we, as you guys know, last year we did about $106 million of assets. When we buy, when we look at the assets, we look at the portfolio theory. That means there are some projects associated with the risk. There's some risk associated with the project, and also risk associated with the market. And the projects could be different phases. Some new development, some lease up, and some could be value add. So we mix and match it up. So from the investment perspective, we try to look at our investment together in a portfolio from the portfolio theory, right? We want to distribute the risk geographically. You want to distribute the risk by the phases to make sure that we downside we kind of mitigate the downside of investments and put our investment closer to the upside. So from that perspective, we have a portfolio approach, a little bit more finance view of it. Then wherever we buy, it needs to be a proven market, especially on a downturn. We don't want to be in the discovery mode. We get into discovery mode when there is an up cycle, not the down cycle. So we're staying closer to the core areas. And wherever we buy, it needs to be, again, high growth, high income growth, low cost of living, and has to be a proven market, right? And then how we structure the capital. So we are flexible. Sometimes we'll take projects with a recourse loan. Sometimes we'll take a non-recourse loan. Sometimes we'll bring a pref. Sometimes we'll do all retail. So it all depends on the project. We're not one of those that one of the teams who would specifically do one type of project and one type of financing and one type of way to raise. And that inherently, we believe, makes us flexible to kind of follow the market turns and market cycles. So that's why we look at everything finance first, location first, finance second, and then the project itself. So that's all the places here down on the south side, out to this mile. We have assets there. So in 2022, we purchased assets in Houston, Dallas, San Antonio, Colorado, North Carolina, Atlanta market. We're open. We're looking strongly. We're bullish on Phoenix and Tampa market as well. We have a couple of projects right now under contract. We have this one, and we also have a value-add project in Dallas and in Houston, and also in Georgia market coming up. Full disclaimer, it's a 506C, so all the investors are accredited investors, so we can talk everything about it. So again, it's not a 506B, it's a 506C. Then again, putting everything together, so our skill set, when we buy assets, we cut across almost most of the value chain. We buy land for development, and also we buy existing value-add assets there as well. So in this particular project, so we'll talk about the land development. And going back to what Vlad was mentioning early on, it's sometime who, not how. So we understand when to push the who and when push the how. For us, whenever we feel like the project is good, it economically works out, financially works out, but skill set perspective, there's a gap. We'll reach out, we'll partner with the right team, has the skill set to make sure the project gets delivered successfully. So in this particular project, we partner up Massive Capital and PSC. We partner with a local developer, and we'll talk about that. That's what our partner delivered this project. Is Andrew online? I don't see it. Okay, so I'll introduce Andrew and Rick. So as you can see, Andrew and Rick, they're about 5 years into the land development business. He grew up in the operations, but then he went to a land developer. He lives in Austin with Rick. Rick comes from the new construction side of it. His family owns a construction business. Even though he's young, has a lot of mileage on him, he understands the new construction, the new development portion of the business. And Andrew, he loves the technical side of it. And this, I believe, is 8th land and development project. So he likes land development. That's all he wants to do. That's his specialty. And he bolt-ons to the view of the new construction. So we partner when we saw this project. When Andrew and Rick brought this project to us, we thought it makes sense because their focus is on the land development. Our focus is on the project and also team delivery and making sure that economically and financially the project works out. So that's how we partnered. And those are some of the projects that he has right now in the mix. He has full cycle 1.5 projects. So one is almost one done in terms of a land entitlement process and exiting with the profit. He has 9 in the pipeline and 1 finished. The other one is 0.9 about to be sold. I believe it's pre-sold, and then rest of in the process. So one of those good things about is he is introvert, but when the time comes to talk about projects, he loves it. He can go days talk about projects, if you ask me. So, and Andrew, if you're in, just join in. I just don't see you for now. Right. And then our partner, Paul. Paul, do you mind introduce a little bit about you and your team?
Sure.
Continue with the slides, please.
Sure. Thanks, everybody. Great to see everybody here tonight. So we are PSC Properties, and we are a partner of Massive Capital doing deals. Some of these deals, of course, on the side there are deals we have done together. PSC Properties has been around about 20 years. we have done about 40 full cycle syndications, which translates to an asset value of about $500 million. We mostly do development projects. Currently, we have about 1,000 apartment units under construction, and that's what we do. So we've been doing some of that up north, and now we are here in the Texas market and the Sun Belt, as Schreier just showed. So along with being in my real estate career, I was a head and neck surgeon for the last 30 years as well, and just retired from surgery last year. Also a chairman of the board of a physician-owned surgical hospital. So I like medical office. I feel like I understand the governance of hospitals and of medical office. Also on the board of a international company, Medical Facilities Corporation out of Toronto. But so we're excited to be here doing these projects in Texas and in the Sun Belt and working with Massive Capital. Ryan is our vice president and takes care of our asset management, acquisitions, and market analysis. Lacey is our creative lead, and she does all things graphic design and web design and all of our copy and journalism parts of it all. So big parts of our company, and we really are in a growth mode and looking forward to do more projects. So love this project, and we'll talk a little bit more about this in a minute. Okay, so continuing on here, kind of about our story about this Austin Gateway project up in Georgetown. If any of you know the Austin metro area, it's in full growth mode, 360 degrees around Austin, and it's a phenomenal area, and we love that Georgetown market. First of all real estate, as you all know, is all about relationships, and our relationship with Massive Capital has been a very strong one, and we're looking forward to continuing with that. We're developing a lot of processes and putting that all together along with all of our projects. The other big thing about real estate, of course, is location. We feel like this area, Georgetown, this is awesome. In specific to this site, our development team with Andrew and Rick, they have done a lot of due diligence around this area and in this Georgetown area. And just 1 mile from our site, they were looking at developing another site. So a lot of good local knowledge that's very, very important. We feel like we got this project at the right price point as well. This project is 10 acres, and we were able to come in at an offer price and acceptance of $2.7 million, whereas just literally kitty corner across the road is another 10 acres that they are selling for $3 million. So we feel like we got the right price point here, good location, all of that added up. Again, there's a lot of new development around this area. We feel like we're almost an infill project here, and we'll talk about that here in a minute. And then obviously the whole situation right now with our economy, what's going on and where are we, and nobody knows, of course, right? So we feel like in development, it takes a couple of years to get entitlements and permitting and all of that. So we feel in this situation, the timing is pretty ideal in that when this project is going to start fully in phase 2, that we're going to be probably, hopefully, out of our recession. And then the last thing about the story here is the return velocity. Really, we are returning your capital and your equity multiple of about 1.45 just in 2 years. A lot of projects that you all might invest in might be 5-year projects, 7-year projects, and you get your money back after 5 years or so. This one comes back to you sooner, in about 2 years. And again, here's our location situation with with real estate. You can see our site there in the white. Again, we feel like we're an infill, new development all around us. And again, Sun City, the Del Webb Sun City, that's right there by us. And as you all may know or heard about Del Webb sites, they're very popular and they fill up fast and they create development around them. And so there's a lot going on. That area right there, you can see Shell Road, and this Shell Road is kind of a key to Georgetown itself. And that Shell Road is about to be widened again. And we don't have the exact timing of that, but we feel like we're on a major road, a major area in Georgetown itself. And just some renderings a little bit about the townhomes themselves. I think right there's about 26 buildings. This is not our final site layout, but just kind of a preliminary. We have a lot of open space here, green space in the middle. We have water and a pond there, and with the other buildings. And these buildings are going to be 2, 3, and 4 units in the buildings. And so we've got that look. We were looking at, we're talking with architect now as we speak, and all of our civil engineering as well. So just a preliminary kind of a drawing here. This is kind of the meat of the whole project right here, I believe, and what you might be interested in. All of this is projected, of course, but our projected IRR is going to be right at about 20%. That kind of translates into an equity multiple of 1.45 over just 2 years. And again, the 2 years, kind of a very quick return. The preferred return is at 7%, and our LPGP split is 70-30. That's very, very typical. So again, for an initial investment of about $100,000, your distributions would be $45,000, a total return of $145,000 in 2 years. And then, we'll kind of mention a little bit about phase 2 here in just a little bit, but this is kind of the numbers section of this project.
Well, thank you. So I think Andrew, you're here. So this section, I'll give it to Andrew. Andrew, lead the way. So we'll talk about the location and some of the phases, some of the technicalities portion of it in the following section. Andrew, take it away.
Definitely. Thank you. So this project is located in what is called the Berry Creek area of Georgetown, which is in northern Georgetown and just a little bit west of Highway 35, which is a major artery running north to south through the entire state of Texas, south all the way down to the Mexican border, through McAllen, Harlingen, San Antonio, up through Austin, and then up through Temple, Waco, up to Dallas, Fort Worth, and then north into Oklahoma. So pretty major artery there. And this whole area northwest, right around that lake over there, is really growing very rapidly. So there's a lot of infill happening right now. Everything between Highway 195 and the lake is growing in, and we are right in the middle of that. As Paul noted earlier, Shell Road is a major road that comes off of Highway 195 and goes all the way down to the lake, essentially splitting that whole northern portion right in half. So this is going to be the major road that people are going to turn off to access this entire area of Georgetown. As Paul mentioned, that road is being expanded right now. It's a 2-lane road now. It's going to be expanded out to a 4-lane road over the next year or so, year or 2 years actually. So as we develop this project, we're going to see a lot of infrastructure development in the area. There's a lot of new utility development out there by the city of Georgetown to support the growth that's out there. They need more infrastructure. There's more homes coming in. There's more businesses coming in, more commercial properties coming in. And we're sitting right at the heart of that. So this is just a very good area for a project, a growing area. So we're pretty well positioned in this geographic location within Texas and also within Georgetown and the Austin MSA itself. Georgetown has a number of economic highlights. There's a lot of semiconductor companies that are moving into Central Texas and especially in the North Austin area. Companies like Samsung, Applied Materials, and NXP Semiconductors are all building manufacturing here. This is an off growth of bringing manufacturing jobs back to the U.S., specifically to Texas, in the aftermath of the COVID pandemic. Texas is very friendly to businesses coming in and building factories here, and the entire Austin area and Georgetown in particular is benefiting from this. Pretty high median income here in Georgetown as well, which supports then our underlying metrics for sale price, rent prices, things of that nature. Pretty high within the state of Texas and also just within the U.S. itself. So there's a good base of buyers and renters to pull from in this area. This is just a view of the site itself. So the site itself is just a hair over 10 acres exactly. As you can see from this graphic, it's located just off of Shell Road itself, has a lot of road frontage there along Shell Road, which is great for visibility for the site and also access for future residents in getting to, recreational activities, jobs, schools, whatever it is that they need. You're right here on this major road. There's also a secondary access along the back, along a private road. And this is a great thing because with the density that we're trying to achieve on the site, which is 110 units, we're not going to have to, request a variance or any kind of deviation from the normal zoning process and planning. So that's, a huge factor in de-risking the project as well. There's no kind of additional hoops that we need to jump through in order to achieve the density that we want. And then our business plan here. So this project is going to be completed in 2 phases. And right now, as we're raising capital, we are only raising for the first phase of the project. So this first phase of the project, what that's going to consist of is acquiring the land and entitling the land. So as of right now, we've completed all of our early feasibility studies, and we've determined that this project is feasible. We've conducted our environmental reports. We've budgeted, underwritten, done all the market studies that we need to. We've drafted conceptual site plans, which Paul showed you earlier. So we've gone through all the due diligence needed to really confirm that this project is going to be able to progress forward as we see. Now, I'm not going to say that there's absolutely no risk. There's always risk in any investment, but we've done just about everything possible to mitigate that risk early on prior to accepting investor capital, closing the land, or anything like that. So at this point, having done those studies, having done all of the feasibility and due diligence that we can, we are at a point where we feel comfortable closing the land and moving forward with the entitlement process. Now, we've already met with the city of Georgetown and had 2 pre-development meetings so far to discuss things like the zoning process, utilities, all of those types of things. So we've already started that process. We've engaged our civil engineering team. We've engaged our architecture team. And these are teams that we've done multiple projects with before in the past. So by the time we're finished with phase 1, we will have a fully entitled project that will be ready to begin construction. That construction will happen in phase 2, which again, we're not raising for phase 2 now. We don't have all the hard numbers on that one yet. Right now, we're only in phase 1, but we will have a solid project where we've added a lot of value by the time we finish with this phase of the project. This is a rough project timeline. So we will be closing on the property next month in March of 2023. And from there, we'll work through, finalizing our site plan, working on civil construction documents, working on design of the units with our architect and with our structural and mechanical and electrical engineers, and move through the entitlement process with the city. That'll involve submitting preliminary plats, reviewing comments, all those types of things that are part of the entitlement process. During that, we'll also be working on planning out the phase 2. Now, that phase 2 planning will consist of determining build costs, really honing in on, final prices and everything for the phase 2. And as you can see from this graphic, it looks like we're, planning to finish around April of 2024. Now, with development, there can be delays in the process and things that we can't foresee. And so because of that, we've added on a bunch of additional months, a total of 8 extra months we've added on to our timeline, just to make sure that we have enough time to, finish this project. If something comes up, if there's, something unexpected in the market that we don't like, something gets delayed, with the city or with the entitlement process, we've got additional time baked in. All of our investment projections around, return of investor capital, timeline, returns on capital, all of those types of things are projected across this entire time frame out through December of 2024. So there's a chance that, will actually be completed sooner. And if that's the case, the returns could very well be higher than what are projected here. We always like to be conservative in our projections. So we've added, these additional, time and contingencies into our budgets just to make sure that we're able to really overperform on this project.
Andrew, thank you. This was good. So I'll take it from here. For the sources and uses, now before I get into it, we started to raise this project about 3 weeks ago. When we did our first webinar, we underwrote that project at a $1.9 million of equity needed and a $2.6 million of debt. And our exit price was to hit that 20% IRR. It's roughly $6.5 million. It's about a little shy than $15 million and $15 a square foot. And on the right side, we run sensitivity, just to couple that what Andrew was talking about. As we run a sensitivity in terms of a time, we also run a sensitivity in terms of a price. So we think if the recession extends and for whatever reason the market doesn't turn, then hey, what's the bottom will look like? So the downside is the extended recession. We are in there for 2 years out and still it's not turning. Then the base case, which is we're out of the recession, we're catching the tail end of it, or coming out of it, it's about 1.45 multiple. Sell price is 6.5 million. Then it kind of goes up from there. We built the case around the 6.5. But since that 3 weeks ago when we started launching this fund, we went back and renegotiated with the bank. So initially, again, it's a recourse loan. We have a great relationship with the local credit union that we took the loan from. We took 9 loans from them. We paid off 7. We have 2 outstanding. So we have a good relationship. We leveraged the relationship. Typically on a land deal, you get about 50 to 60% of leverage based on the cost of the land. By using our relationship, they offered us up to 75% of the LTC, which is the land plus the entitlement cost. Then we have to do our part of it. When Andrew and I and Paul, we sat down and ran the model, and we thought the optimal loan, it's about, and Andrew, correct me if I'm wrong, it's about right around 70%, plus minus 1%. So with the relationship, what we're able to do, we're able to take $400,000 off of the equity that is needed. So right now we are shooting for $1.5 million of equity raise instead of 1.9. And that also inherently added a lot of breathing room into the project. With that note, we are about 90% soft committed. And I think we are uploading the PPMs and OAs that should be on the in our syndication pro. So again, we're 90% soft committed full. We have maybe probably 2 or 3 spots left. So if you like this project, we request please go to our website, massive.capital. There's a login or sign up page, sign up from there. And on that note, the last raise that we have done, we had much stronger commitment, so we have to give some of the money back. And our take is, look, we want to support everybody. We want to take your funds and place it in a good projects. But from us perspective, until we have that money deposited in the bank account, it's tough to count. So our request is that if you're willing to invest in this project, please sign up. Please work with our team to initiate the wire, and we kind of book your time and also the funds as well. So all in all, it's a $1.5 million raise, $400 million shy of what we initially assumed. That added a lot more breathing room into the project. from the 1.4, we are about 1.4 each. So 1.2, 1.4, right around that range, and it's changing as we speak. So next steps, again, it's a 506c. We'll help you out. I mean, once you log into the Massive portal, and you'll sign in, one of us will call. We'll make sure that we get you the right set of documents to make sure that all the accreditation, all this form that gets filled up appropriately. But we'll help you throughout the whole process. So review the PPMs, then go sign. Once you sign on the system, they should have the wording instruction. Then you fund that as well. We also are taking IRA funds. We work with Quest heavily, and they have been a great support for us. So if you have any questions about the IRA funds as well, let us know, and we'll help you go through the process as well. It takes a little bit more hand-holding for the documentation. Okay. Having said that, here we are. We have Jasmine, Maria, Candice, and Trevor. Trevor is the lead for this project. Any questions you may have, reach out to any one of us, and we'll help you. We'll support you throughout the whole process. All right, that's all we had for the day. And sorry, the access to portal will be, it's www.massive.capital. Once you go to the website, it pops up on the top right, so you can log in from there. Okay, that's all I had for now. We're gonna open up for Q&A. Trevor, if you would help me, some of the questions you may have. If I miss something, we'll go. So hey, please ask away all the questions you may have. Those are the good times to ask. And we'll be transparent. We'll share what we know. We'll share what we don't know. And if the question gets too deep, too wide, we'll take it offline, but we'll revert back to you within a day or so to make sure that we give you all the information that you asked for.
And just a quick little bit. So this property is less than 30 minutes to my house. So I know this area very well. All the development is going crazy out there. It's also really close, 30 minutes to Tyler, where there's a big factory being built. And so there's a lot of development. It's 35 minutes to downtown Austin. So it's a really good location. So I think Luke has a question. See, I think you can unmute yourself, sir. Try that.
Yes. Yeah, thank you for the information. I was wondering if you could go into a little bit more detail in terms of, if the projected turnover to a builder is kind of in the 18 months to 2-year mark. If we were to draw a radius around the property, what other properties will be build ready kind of in a similar time frame? And then what sort of engagement is happening with builders, recognizing that, their build window could be a 3-year, stack, if you will, for them to, take on projects. So maybe if you can talk about that a little bit.
Okay. So I'm
happy to take a look at that, Schreier.
Yes.
So like with any development project, our first goal is to sell the lots themselves to builders. And, what we have found in the past is we literally have competition amongst builders for a project, something like this. No guarantees, but again, some builders will buy anywhere from say 3 to 5 to 10 lots at a time. And so we'll see how this goes with that. I think this is going to be very attractive to townhome builders. And then from there, that we're done with that lot after they build it. And then they have to, of course, go ahead and build their lots, and we'll have covenants and how they build it and all that sort of a thing. So a lot of that comes up onto the builder itself, and we will have some control over who we sell them to and their experience in townhome building. The other part of that is to be involved with the building itself. And we kind of haven't really determined that exactly for the phase 2, if we will be involved with the building or not. We're still putting our numbers together. So again, this is just a land play right here, right now. And so the rest of that would be kind of up to builders. And tell me if I've answered your question or if I'm off somehow.
Yeah, I guess my question is more, obviously the exit is the sale of the lots, right? And,
right.
That's going to be driven based on buildable lots in the area at the time these come online, as well as sort of if builders are wrapped up in other projects and can't build, that means they don't buy. So it was more a question around, kind of the dynamics of available buildable properties in a similar time frame, as well as kind of the builder depth, if you will.
So maybe Andrew or Rick, Rick has that construction experience. Maybe Andrew, if you can tackle that availability. There is regular homes being built across the street, but no townhomes to my knowledge.
Yeah, that's correct. There's, to our knowledge, no active townhome developments in this area right now, which is part of the reason why we chose townhomes for this specific project. There are apartments going up in the area. There's commercial, there's self-storage, there's single family homes, but no townhome units. And we feel that townhome units actually fill a much needed gap in the market, which is that bridge in between apartments and single family homes. I'll also mention most of the single family homes that are being built in the area are higher end homes. So at the price point that we'll be targeting with these townhomes is quite a bit lower than those high end homes, which provides a nice middle point for some, first time home buyers to get into the market, young families that are looking to transition from renting into buying, or also for, retirees and folks looking to downsize, folks that maybe have, a larger home somewhere, kids are grown in out of the house. They don't want to deal with the hassles of, keeping up with, their own lawn and all their own stuff, and can, have some of that taken care of by an HOA, which is what this community will have. So, this will be a pretty unique project within the market. So, while we, of course, will have competition from, apartments and single family homes, it's going to be indirect competition. We'll be filling a very different need. There's not going to be direct competition with other sales.
Just to kind of build up on those two. So this new development right here, it's about 120, 130 lot developments. They almost sold out. They have like 15, 20% left. And here it's about 700 houses subdivision, 700 something. They already sold about 60, 65% of it already to large home builders. And they have about another couple of hundred lots are open to sell that they're marketed. And our exit price, so we shopped everything. So our goal is that 2 years from now, they are sold out. There are houses over 1,800 square foot to about 2,500. Some goes about almost 3,000. Here it's about, some 1,700 to about 2,500. That's the range. Then 2 years from now, we assume this is almost done, and they're going to be selling the lots already, and then building it's going to be remaining about 15, 20% or so. But then question is, what is the exit price? How do we prove the price, and how do we have confidence on the price? So we said, look, we don't know anything about anything. Market's going to go crazy, but as long as we meet or beat the price of today's asking price for this land, 2 years from now, we earn the money. Can we pass that scenario? And that's exactly what we did. Our exit price number is their asking price today. Yes, I understand. If I go there, offer them 10% lower, they're going to take it. So we're going to go through the time, come back out. We still feel comfortable if we can pass the project with economic profit at the asking price of today's land, then 2 years down the way, we'll be in a better side of the market. And that's how we modeled it. So, and also by that time, there are houses, high-end houses, there's apartments. Between the apartments and houses, you got a wedge. So it's a unique, but it's a required wedge that we created the product in that right in the middle. Good question, Luke.
Any other
Yeah,
questions?
question.
Yeah, some people, I'll let somebody else go, but some people were asking about the portal again. I put it in the chat. If anybody missed that, it's in the chat, the portal. And
I have a question.
also, I'll repost. There's also a WhatsApp group. I'm just going to share while you guys are thinking of questions that we share a lot of information in about deals and what's going on in Texas, especially. So if you guys want to join the WhatsApp group with us, please feel free to. And Trevor put the sign up again. So I'll let you guys get back to the questions. Thank you.
Can you hear me?
Yes, please.
Yes, thank you. Hi, so my question is, there was one slide that was shown where the worst case would be 35%. That's still within the 2 year span, or you're projecting?
So let me make sure. He's talking about the pricing sensitivity?
Yes, yeah, this one,
Yes.
correct.
Yeah.
But
Is it all 2 years?
the worst case, correct, is all 2 years window, right? Now, what if the recession goes more than 2 years, right? How would the numbers look like?
Yes. So I'll give you a long-winded answer, then I'll give you a short answer, right? So what we talk about when we mitigate the risk, there's some tail end risk associated with it. And likelihood of happening that 0.000 some odd percent, but if they happen, they're expensive. When we try to solve it, we try not to optimize for that, but at least have a potential avenue to it. So the mitigation is not the price, the mitigation is the time. And when we did the finance structuring here, it's the relationship, right? We got 2 years of interest only and a 1 year extension. So let's see worst come to and something happened, worst to worst. We don't know what it is. Another COVID shows up a year and a half from now, right? Another year we're out. So we have baked in an optionality where we can go back to bank and say, you know what, we'll extend the loan for another 1 year interest only, so you can float the project on the other side. So that's our mitigation in terms of the time, because and on the back end we did not mitigate any price because Austin behaves a certain way when the recession happens, and different recession has a different pulse to it. This is not a financial recession. This is a economic recession deliberately trying to put out. That doesn't quite fit into the Austin a little bit because Austin, it's a halfway in the middle. Austin, the bias for this location is the high-tech fabrication, which is here to stay because of the Taiwan issue and some of those web tech job loss that we're saying. That's, some of them in Austin, but not a whole lot in Austin, especially in Facebook. But again, those are highly paying jobs. They have money. They're not going anywhere. And another good thing about Austin is Austin and Denver, they behave very similarly when market shifts. They jitter a little bit higher, but they bounce back much faster than the market. In other way, if the market, think about it, if the stock goes up a little bit, Austin will go up much higher. But if it goes down, Austin goes down much deeper, but it comes back up pretty faster. So when we run the economic model from that perspective, we just don't see the price going anything where we're going to lose money, at least in a 3 years window. And worst case scenario, we extend the interest only payment, and we float the deal. And within the project, the question is, how much the money? Within the project, we have contingency baked in, push come to shoves. That contingency money is big enough to float the deal for another 1 year.
Okay, thank you. And just a couple more questions. So I heard if you take Dallas City, right, it takes a long time to have this monthly meetings and stuff, right? So I don't know about Austin. Do you think you can get all the entitlements done within a year and a half, like what you projected?
Andrew?
Yeah, I can take that one. Yes, so we do have a pretty good relationship with the city of Georgetown, and the professionals that we're using for this are our zoning consultant, our entitlements attorney, our civil engineering team, our architecture team are all very familiar with the area and have done multiple projects in the area before. And our timeline that you're seeing here that's timelines that we've discussed with them, that they've given us, that we've discussed with the city. And that's how we developed this timeline. This isn't something that we just kind of came up with out of nowhere and said, this is what we would like. We've actually spoken to city officials and our experts about, hey, how long is it going to take to get this piece of the project done? And how about this piece of the project? How long is it going to take to compile our platting packets? How long is it going to take to complete construction documents? How long, in your experience, does it take for the city to review these documents, to provide comments? Like all of the steps we've gone through in developing this timeline. As I said, we've already had 2 pre-development meetings with the city of Georgetown. They've been very amenable to this project. They like this project. They want to see it go through, which is why we're so confident in it. So we feel very confident that we'll be able to move through this process, within this timeline that we've projected.
Okay, understand. Thank you.
Just to add on to that one, that we did not start from base zero in this particular project. That's because Andrew and Rick, they did quite a bit of homework on a property a couple of 100 feet from there. So the location know-how was there within the team already. So we had some homework done before this property came along. So it was not a base zero, it was a base something, right? So that gave us a little bit more confidence, some engagement. It's less of a get to know you type conversation with the city in this particular project. Andrew and Rick already had some relationship. We kind of leveraged that. And that's why we feel comfortable with the timeline as well.
Okay, got it. And just one more question in the slide on the phase one, right? So if we were to sell this lot to a home builder, then we will not be doing any phase two development, right? It will be some other folks taking care of it. When would phase two really happen if we were to build it?
Right here.
Meaning, yeah, when meaning, maybe I should rephrase my question. My question is, if we did not sell it to a home builder, then we will just restructure this, and another entity will buy the phase one, will close phase one, and they will take out the vertical building. Is that how it works?
Yes, something in that line. So what's going to happen? We'll do
Okay.
a refi on the construction loan, and that's what we're saying. The investors coming in now, they have the first right of refusal. If they choose to stay, the economic profit for the phase one will roll into the phase two, and if they choose to exit, they will exit. We'll bring in new investors in. So that's what here, that investor return will happen from the sale, either to us or to somebody else. And if it's to us, then it's going to fair market value. We'll get some third-party opinion appraisal. Based on that, we'll do the transaction. And investors in this phase, they get a first right of refusal, and that investment structure for the second one will be different, but you get roll over the phase two.
Okay, got it. So just a follow-up on that. So if you were to buy the property at a fair market value, would that be the bottom? Would that be the 16% return?
So fair market value. Okay. The first question is, I heard two questions. One question is, how do we make sure that phase two is protected, right? And then at the flip side is, how do you make sure that we are fair to the phase one, right? And then the pricing. So the fair market, if the fair market is $18, let it be $18. Phase one folks will get $18. Our philosophy is that each of the project must be standing alone by themselves. We should not take the profit from one phase, give it to another phase. And it's not fair to both parties, right? Both parties are taking different kind of risks, and they have a different kind of return exposure, and they should be getting risk-adjusted return. So fair market will be, look, I go to, hypothetically, I'm just throwing some numbers out there. We go to market, it says, hey, it's $6.5 million. Then we're like, okay, $6.5 minus the transaction cost. If I were to get a broker, that minus that will be your fair market value cost, and we take it from there. So we do the phase two based on that phase one. So all those calculations that we're going to do in a phase two planning, or whether we take it or not, that will be based on the fair market value at that point in time. What it boils down to is that we update the underwriting model almost, we've been updating this almost bi-weekly basis. When we get into the phase one, we'll update the model as the number comes about every 2-3 months or so, till the point we make sure that, it's ready to go. So
the reason I'm asking a question, the reason I'm asking a question is, in case we don't if we don't find a buyer, right? Then this will be an exit plan out of phase one.
Yeah. So okay. So let's run the scenario. Let's say we go to market on quarter two. Hypothetically, we go to market in quarter two. That gives us 8 months. Either we're wrong or market is wrong. Or market is right. Market's in a different spot versus our pricing, right? Plus, we have another 1 year. I bought over a couple of hundred. Paul did 40 full cycles, right? In a year and a half, we should be able to sell a property. Either we place it or we do it, or pricing is whatever it is, right? So we have enough breathing room to getting into the strike time before we get in. So we got 8 months of heads up, plus 1 year of extra if we slip. Within a year and a half, we should be able to place the product in whatever hand it is, right? If we think product in a good spot, we'll exit. We'll, if the project is going somewhere else, market turns, then we'll decide, right? So the downside to us is this is mitigated. I mean, it's much more mitigated than the upside in there. But again, going back, whether it's if the market doesn't turn, extended recession, do we see our follow Powell that recession is going to happen 2 years out? I just don't see it in the market price, right? We can pull out the macro data, it's just not there. Then Austin's overlay, Yeah, Austin's taking a beating. It is getting a bad press, and that's fine. That's for 6 months, 1 year. Then it's going to come back out. And then it's a land price, right? I personally do land trading. I do land banking personally outside this one. I trade 50 to 60% of land every year. So we understand the land price. So on that land price, if I don't do anything, land price will go worst case constant. Then we're adding entitlement, adding a value to it. So price of the land will go up either way. So we feel comfortable on the downside. Good question, though.
Thank you.
Justin,
Can I jump? Oh, sorry.
Please.
Go ahead, Trevor. What?
Justin has a question.
Oh, I thought it was just, who was, oh, okay.
Hi. There was some of the things that I was going to answer just recently. But my question really is around the pro forma and the different evaluations. I love that you all have done the diligence to show us a couple different scenarios of what it would look like. And I joined the call a tad late, so I may have missed it if you covered it, so please forgive me. But in the event that we do land in a recession or something to that nature for a longer period, I would just assume that my return, if it was from a year to 3 or 4 years, that we are unable to, get paid out a disbursement, would that interest continue to compound annually?
Yes, the 7 pref, that's going to compound annually. So the more you stay, the longer the compounding is. And then if we're to extend, we have some buffer, some contingency baked in. That is the cost of money we're going to reallocate to holding cost for a year. So there's no net increase of the cost. Net increase is already baked in. In a sense, we can run this project every 6 months and return should stay the same. So yeah, the first question is the 7 pref, it's the compounding. If you stay for 3 years, the 21% of first 21% of the total return goes back to the LPs. And if you stay 2 years, then first 14% of the total return goes to the LPs. Then any distribution happens to any GPs and everybody else. Okay.
And I guess my follow-up becomes, right, in a sense, like you mentioned earlier, we're in a recession right now, economic, but if it's something like another COVID, which is highly unlikely in my opinion, there was a lot of panic sales that happened in which it affected the market in general. So if we're in the middle of a deal and, hey, you all make a decision to say we have to kind of sell before we lose our shirts on the deal, how does that impact the returns if you have to sell at a significant discount to kind of break even, but you've already kind of, guaranteed return? So how would that work?
Sure. Before you give it a second, before you answer, let me do a couple quick things. Then I'm going to jump out and let you guys finish up the questions and answers. Hey, Justin, nice to see you. Are you out in Vegas?
I am.
Hey, man, I saw you connected with our guy, Chris Craze.
Yes.
All right. So tell him Mike Bailey said hi. Just wanted to say that first. Wished I was out there with y'all. The other thing I wanted to say real quick is Mike Menudo put in the chat. So we are in partnership with Mike Menudo, Deal Doer Machine, Massive Capital, for basically a package of mentorship and mainly around tools that lets you get into Red IQ and some other underwriting tools with access to some CoStar and Reonomy. So I'm going to repost that, but take a look at that if you're interested. And then the other 2 announcements is if you want to catch up or know a little bit more about Massive Capital, reach out to Trevor Thompson. Trevor I know he's put his information there. So reach out to Trevor as well. And I had one more. The last one was, before you finish, Ryer, just let, if they're still on, or do an update with Jonathan and Maria on the status of the investments ready to go. We're up in the portal, things like that. Okay. Sounds good. Thanks, Mike. Thank you. I appreciate everybody tonight. You guys have a good after party. Justin, nice to see you. We'll catch up soon.
For sure. Thanks, Mike.
All right.
So Justin, I'll answer your question, then I'll go to Jeff, and then Maria, if you could come back and give us an update on it on the docs, I'll really appreciate it. So Justin, a couple of things, like no projects, no investments are guaranteed to make any money, right? But what we try to do is that we try to make the best choices at this point in time to make sure that our decision on the better side of the upside and against the downside, right? On that note, let's say we are at a point we broke even.
Mhm.
Then we broke even. Everybody got their capital back. And let's say
Okay.
we're at a point 2 years from now we make 14% exactly. Then what's going to happen? The whole massive capital, whole PSC, whole IronGall, we work for zero. First profit goes to the investors. Now let's say we make 15%. 1% comes to us, 14% goes to everybody else, right? Hey, now, and the last thing, this is the recourse loan, and we have our money invested. Recourse means that if bank comes takes it, 100% of the balance sheet on us. So we are much more invested into this deal than compared to the LPs, if you ask me, right? So that's the question. And to disclaimer, I think, and us, we're one of the handful of team who are comfortable to say, look, there's no guarantee. All it is at that point in time, we are making the choices, looking at 3 years. That is the better side of the market, right? We want to be closer to the market. We don't want to go against the recession. We want to be on the side of recession. We don't want to build a plan on a 4% interest rate. We want to build a plan on a 10% interest rate. I want to be on the side of the market, right? I want to do everything on the side of the market so it kind of goes up. Right? And then, if it slips by 2 months, I don't have any control. If city calls up and call Andrew, say, look, the road is I'm doing it, it's going to slip by 6 months. We don't know. We don't have any control over it, but we have baked in 8 months. If it slips by another 2 months, let it be. But we're going to kind of, work through the process as you kind of go through, right? So thank you. Hopefully that answered your question, right, Justin?
That was it was the answer I was looking for. Honest, just real perspective, and I appreciate it.
No problem. Thanks. Jeff, buddy, you got a question? Jeff, you're on mute. We don't hear you.
Yep.
Okay. And Jeff, whenever you have questions, please just let us know. For now, Maria, would you mind sharing a little bit more where we at?
Schreier, I'm not sure Maria's on. I don't see her in the list, but I can give you an update. The
Please.
docs just got uploaded. We've got the private placement memorandum for review, and then we have the subscription agreement and the operating agreement available for review, and hopefully everything is set up and ready for signatures.
Thank you. Thank you. So everybody here, that's our website. It's not massivecapital.com, it's massive.capital. When you go, you can register for the next webinar, and then you go to log in or sign up. If you go to sign up, it's going to take you to a syndication panel, then our portal. The link is on our chat box, and that should be it. That's my top secret password, but hey. So on that note, I think this concludes our session, and we typically take a 5 minutes break. Then we come back and hang out for 15, 20 minutes to have other questions, comments, and some of the things that we do. It's there. So,
and then just a quick thing, I'm going to post it in the chat. Tomorrow night we have Jasmine, who was mentioned here. She's actually out hanging out with Grant Cardone. So if you look at our Facebook page and LinkedIn, she's there. But we're going to do a little meetup, and she's going to talk about the power of proximity. And if you've not heard Jasmine's story, she's a rock star. Like, came to America not speaking English, just amazing journey. So sign up, come and join us, and hear her story.
thank you. Paul, anything you want to add? We close out, go for the after party.
No, just in doing a whole bunch of development projects in the past, this one is pretty unique in the speed of which you get your money back. And I think we've mitigated as much risk as we can. No project is without risk, of course, as Schreier said, but this is pretty darn good in a great location, great market.
Thank you. Andrew, any closing remarks? Are you good?
Good. Thanks, everyone. We appreciate you jumping on with us.
Thanks, everybody. And again, so this ends the session for this one, and we'll take a couple of minutes, then we'll get into the following session. We'll just hang out. If anybody would have any extended questions, or if we have any other questions for any other projects, we'll continue here.
May want to stop presenting just so we
okay.
can see each other.
Thank you, Andrew. Thank you, Trevor.